let's move on to talking a little about our Impact NBFC report and some broad insights that have emerged from our analysis. My colleagues, Ramraj, CEO at IIC, Pragya Gupta, Senior Advisor at IIC, and I will be making a short presentation on our report findings. Now on to you, Ramraj, to begin the presentation.
Thank you, Vedant. I think we are running quite a bit late. I think about almost 20-25 minutes late. So I'm going to first put a bit of a hatchet to our presentation. We had 15 minutes. We'll try and wrap it up in 10 to 11 minutes. And then subsequently, I'd request all the coordinators and the moderators of all the panels, instead of taking 45 minutes, to please take 40 minutes, so that hopefully we'll try and make up a little bit of time as we move along and finish as per the time. So on behalf of IIC Northern Arc and TransUnion, it's a pleasure for us to be presenting this report. Genuinely, this report is a labor of love. It's really taken us a long time and a lot of energy and effort to get a lot of support and a lot of information and analysis, both from Northern Arc and TransUnion CIBIL, to bring this together. The IIC, very briefly, is, we are a body, a not-for-profit industry body focused on supporting the impact investing ecosystem. And clearly, financial services and impact NBFCs are where impact investing really all began, at least in the Indian context. Let's move on. We've already, you all know a little bit about Northern Arc, but really, as you will all know, formerly known as IFMR Capital, it is a platform in the financial services sector, which really supports a lot of underserved households and BOP customers. TransUnion CIBIL is one of the leading credit bureaus in the country. I think from a credit information company, it's rapidly transitioning into becoming a credit analytics company, and really, have been working very closely with both Northern Arc and TransUnion on this particular project, and hope to continue to do a variety of efforts and continue this small NBFC agenda beyond just this report. Let's move on. Very quickly, I'm sure, and we have just discussed this briefly, and how are we defining impact NBFCs? And really, and I think Mr. Vishwanathan asked an interesting question about the larger NBFCs. I think our real focus here is really on the smaller ones. We have defined them as AUM less than 5,000 crores, and at least 75% of their portfolio, really comprising of one or more of the following: loans to micro and small enterprises less than 1 crore, affordable housing less than 25 lakh rupees, new and used vehicle finance less than or equal to 15 lakhs, agriculture, microfinance, and other sectors, typically, that's really the way we've defined it. And this chart on the right will give you some interesting data, which really says that if you really look at CIBIL data, this is really about 1,50,000 crore AUM market. Half of it is MFI NBFCs, half of it is non-MFI NBFCs. But what's very interesting is really the table at the bottom, which will show you that, if you look at between 2017 and 2021, the number of NBFCs which form this cohort, and we have broken it up into three buckets: less than 500, 500 to 2,000, and 2,000 and more. What we really see is that very few NBFCs are crossing this kind of a threshold of 2,000 CR. So what's happening is you're getting a lot of new guys coming along and setting up shop, but not too many of them are really reaching a certain critical size and scale beyond which they can really, sort of create a very different nature of scale and size and impact. And that's really the nub of the conversation that we are trying to kind of catalyze here. Let's move on. Very quickly, I've already spoken about what the research objective is, showcasing the opportunities and challenges for this ecosystem. The broad hypothesis of ours, if I have to articulate it to you, is as follows: that it is our sort of, if I may say, humble assertion that these small NBFCs really, relative to their size and scale, I think it's important to mention, combine good social impact for their beneficiaries. In general, the returns they create, whether it is for debt finance, instruments or equity finance, I think in general, they have created good financial returns. And by and large, also displayed a decent amount of innovation in a variety of areas. Notwithstanding that, this is a sector which impacts funding challenges. And therefore, there's a need for us to think about, what kind of ecosystem support is possible for this particular sector is really the broader hypothesis. Our methodology really for undertaking this analysis, and you will all get the copy of the report and we'll put it up in the chat box, the link from where you can download the report. But essentially our methodology has three broad buckets. One is, there is a macro 4-step framework of looking at these NBFCs dispassionately from 4 points: business resilience, social impact, business model innovation, as well as financial returns. So that's the first part of methodology. The second part is really a deep dive into 100 NBFCs which are supported by Northern Arc, understanding how these guys have been doing, what's their financial performance, what's their business performance, and so on. And the last part is really voices from the ground, interviews with about 30 Impact NBFCs and their CEOs to understand what the real pain points are, where are their challenges, and what is it that they believe can really help. That's the way we have created the methodology for this analysis. And a lot of what you will see in the next few slides is really around the core of these three big heads. Let's move on, Vedant. Quickly, as we spoke, the analytical framework part one really looks at what kind of social impact are these guys creating. How much of their business is coming from tier 2, tier 3 geographies? How much of their business is coming from first to credit customers? Which side of the portfolio is growing? Second part, what kind of innovation are these guys creating? What kind of new credit models are they developing? Is there any newness in the way they are acquiring customers? How are they enhancing their collections infrastructure to continue to remain relevant in a space which is dominated by low-cost, CASA-funded private banks and so on and so forth? Third, notwithstanding this sector, and if you go back in history, on an average, every 5 years, something or the other has hit this sector, the NBFC sector. And I've seen this sector for 25 plus years. Every 5 years, something or the other comes which really creates a greater sense of vulnerability, at least a perception. So how has the sector done over a period of time? And lastly, what kind of financial returns are generated? What kind of financial returns have they given their investors? And yes, this is a little bit of a bias because we are looking at the survivorship of those which have actually listed and so on. But nevertheless, what's the kind of financial returns that a lot of these guys have prepared? So that's really, in brief, part A of the framework. I'm now going to hand over to Vedant to take you through, and then subsequently, I think Pragya will come in and kind of give you a quick summary of the analysis. And as we said, we'll try and kind of keep this to 10 to 11 minutes. So over to you, Vedant. Let's move
on. Thank you, Ramraj, for the holistic overview of our Impact NBFC report. One of our most important agendas when formulating this report has been to sort of showcase the social impact narrative of Impact NBFCs, as the term itself suggests. And we've used both qualitative and quantitative data points to do so. So our analysis shows that 1 out of every 3 customers supported by Impact NBFCs is a first to credit customer. That is, individuals who have not been served by the formal financial markets before. And on your right, you can see that in Q3 of 2021, this figure was around 20% for Impact NBFCs, as opposed to 12%, which is kind of like the aggregate figure for other lenders, including other non-banks, private banks, and public banks. And this figure has gone down in recent years, but that's largely a consequence of the COVID-19 pandemic, as more and more lenders are focusing on securing their existing portfolios rather than acquiring new customers. We also see that more than half of the Impact NBFC portfolio funds customers in semi-urban and rural areas. So around 52% of the Impact NBFC portfolio as of September 2021 is from tier 3 and tier 4 geographies. And this is higher than that of all other formal lenders except public banks, which makes sense because they've operated in rural regions for a far longer time and are traditional lenders in that space. Next slide, please. Our data also shows us that Impact NBFC portfolios continue to grow faster in semi-urban and rural areas, with more than 40% of the growth in tier 3 and tier 4 geographies, as compared to roughly around 13% in metros and around 26% in urban areas. So this kind of shows that, and also underlines that Impact NBFCs continue to sort of deepen their offerings in India's rural hinterlands, where more of the unbanked populations reside. Next slide, please. Now, the second pillar of our research project on Impact NBFCs has been to sort of highlight the deep-seated innovation in the sector. And we kind of really see that innovation lies at the heart of Impact NBFC's efforts to cater to sort of diverse segments of low-income customers. And as mentioned before, many of these customers do not have prior credit histories, they earn irregular wages, and are not really digitally savvy. So when we take a deeper look at this innovation, we see that it's essentially built across the customer journey, right from targeting and identification to acquisition and onboarding to credit underwriting, and then also servicing and collection of loans. On your screen, you're going to see some of the notable ways in which these Impact NBFCs have been driving innovation, like, for example, hyperlocal marketing and acquisition, the use of technology and credit analytics to improve credit underwriting, bringing in efficiencies in cost management and cost structures, and also a great emphasis on a customer-centric approach. And ultimately, all of this leads to an increase in the lifetime value of customers. In our report, we have touched upon innovation case studies in a much more detailed manner, but in this presentation, I'll briefly sort of go over two instances of Impact NBFCs driving innovations. Next slide, please. So on the left, we have an NBFC that's sort of focused on the SME and agri-lending space. And this NBFC is trying to sort of better serve its target borrowers who are primarily farmers with seasonal incomes. And we see that in order to do so, this NBFC essentially developed a digital platform to enable farmers to design customized repayment schedules, depending on when they're more likely to make a sale, let's say by going to a local mandi. And this platform ended up becoming so popular for this NBFC that they began offering other value-added services on it, such as online store creation, billing, accounting, and inventory management, all of which effectively helped them convert these first-time borrowers into lifetime customers. Also, when it comes to, let's say, targeting and identification of potential borrowers, particularly those who reside in smaller villages, it's incredibly important for NBFCs to build a strong level of trust with these customers. And this is something that an affordable housing NBFC that you can see on your right sort of realized when they wanted to further their operations in India's rural hinterlands. This NBFC found that the most effective way to sort of identify the best borrowers is by leveraging influential individuals in these local villages who are most trusted. And this included women who had a high social standing, Anganwadi workers, and also NGO workers who would sort of volunteer in these villages. And they eventually hired them as part-time ambassadors to source clients. And more recently, they've also roped in kirana shop owners to sort of further their outreach in local communities. So as you can see, both these cases sort of reflect the importance of innovation for Impact NBFCs and proliferating their business models. Now I'd like to hand it over to my colleague Pragya to take you through the rest of the presentation.
Thanks, Vedant. After impact and innovation, the other key component of our framework is resilience. As we know, the NBFC sector has faced multiple crises, the most recent being the pandemic. Impact NBFCs, especially the smaller ones, have faced a negative perception as an asset class, and we reviewed 3 data points to understand their resilience and performance better. On disbursements, we noted a recovery to pre-pandemic levels for the sector, which showed a stronger positive uptick post the second wave. Secondly, asset quality increased across the BOP credit segment and continues to be a concern, yet we also found that most Impact NBFCs are sufficiently capitalized and have created loan loss provisions for their portfolio at risk. Now, while asset quality NPA is the most common metric when we think of resilience, we also reviewed borrowing performance of Impact NBFCs. And you will see this in the figure on the right bottom, where the bureau data on borrowing of more than 200 Impact NBFCs shows that contrary to the negative view, these NBFCs have displayed resilience. Only 4% in number and less than 1% in value of default was noted in the borrowings data. This is much lower than industry level GNPAs on bank borrowings and shows also the continued resilience. Next slide, please. The last element in the macro framework is of returns, where we have actually looked at both pre-IPO investment as well as post-IPO investment returns. In the chart, you will see that the last 2 columns on the right represent the average multiple on the investments. While our analysis, as Ramraj highlighted, only includes successfully listed NBFCs, the average gain on investment made pre-IPO was 4.5 times versus 2.1 times post-IPO. We also noted that of the 16 NBFCs which got listed in the past 10 years, 75% were either HFCs or MFI/SFBs, with only 4 being MSME lending focused institutions. This again shows that a deeper regulatory support as well as a developed ecosystem for both microfinance and housing finance NBFCs has helped them scale much faster than MSME-focused NBFCs. Now, despite this returns potential, investments into traditional NBFCs has also dropped post the pandemic, and we find a gap of $30.9 billion in debt and $7.7 billion in equity, which will be needed by the sector in the next 5 years. Let's go to the next slide. The second section of our report basically looks at 100 Impact NBFCs in much more depth and really understanding their funding challenges in greater detail. As shown in the table, we've classified NBFCs in 4 broad AUM categories of mini, micro, small, and medium. The sector spread is across MFI, MSME, vehicle finance, as well as housing finance. Firstly, we looked at the capital structure, which showed that external equity again is substantially skewed in favor of mid-size and larger NBFCs. Promoter funding, which you see in the chart below in dark blue, is the key source of capital with more than 50% share for smaller Impact NBFCs. This shows there is a critical need for external patient capital at the early stages. As we move to the next slide, where we look at both the debt capital as well as the borrowings data, we find that there are limited sources for smaller impact NBFCs. The chart on the bottom right shows that their primary lenders are often non-banks with severe, again, shortage of low-cost capital, whether from larger private sector or public sector banks or refinance opportunities. This gets also reflected in the lower interest margin as shown in the top chart. We did find that NIMs have reduced significantly by more than 150 bips in 2021 from 10% to 8.5% on an average, putting added pressure on profitability for smaller NBFCs. Lastly, on the debt capital side, we see a heavy reliance on term loans with greater opportunities for non-traditional sources of funding, included blended finance. Let's move forward. Next slide, please. The third section, which I will refer to very briefly, is our survey with 25 leading impact NBFCs, which supported our data findings. The top 3 challenges noted by more than 60% of the surveyed NBFCs were basically regulatory support for smaller NBFCs, challenges in raising timely equity, and increasing cost of debt. Some of the other challenges that did emerge from our conversation, though these were not ranked in the top 3, were diversification of asset portfolio, management of asset quality, as well as operating cost. Now, there is a need for broader systemic support and innovative funding structures, which was noted across from all the NBFCs that we spoke with. And this leads us to our last slide on recommendations, which is the next slide, please. We strongly believe that it is important for different stakeholders to work together towards strengthening the ecosystem by supporting small and mid-sized impact NBFCs and helping them flourish and scale. I'm sure our esteemed panel members and speakers will be sharing much more insights on the opportunities as well as recommendations. Please also note that the full report can be downloaded from our website, and the link is mentioned in the next slide. We are also